He says, I'm trading iron condors and butterflies. Is this webinar discussing them? What deltas do you recommend to enter an iron condor? Personally, I don't use delta. On power options, what we typically prefer to use for strategies such as the credit spreads and debit spreads is the probability, William. The percent probability above for a bull put credit spread. We talked about that about 45 minutes ago related to the cash secured or naked put position. The probability above of 80 and 90%. Based on the past trading range of the stock, what is the likelihood that the stock will remain above or below a certain strike price? Of course, you can use delta in power options. There's nothing wrong with that. But my preference for simplicity, in my mind, and it's not in everyone's mind, I get it, but is to use that probability. And in power options, when you're using the iron condor screen, you have a variety of different probabilities that you can use. The theoretical probability the stock will be above the short put, because of course we're in a bull put credit spread, William. We're combining the bull put credit spread with a bear call credit spread on either side of the stocks. We're looking for our default screen. It's looking for percent probability above the short put to be 75%, and the percent probability to be above below the short call. I'm sorry, William, to be 75%, with a percent probability between of 80% or more. The theoretical probability the stock will remain between the strike prices at expiration. That's what I prefer to use. I actually might go a little bit higher, especially if I'm doing a monthly that's 20 days out in time, 25 days out in time, William. My bull puts that I prefer, I look for an 85% probability above the short put strike price, targeting around a 13, 14, 15% return for that 11 to 14 day trade. And I'd probably look for the same probability between using an iron condor. Okay. Now, what are criteria? We're not looking for high betas. We want neutral positions. We don't want things that are swinging wildly, but just as we saw the previous discussion there, related to X and Fowd's question, the sudden unexpected news comes out, you can have a wild swing, sort of that black swan event that takes you by surprise. But we don't want highly volatile, highly fluid stocks that are fluctuating wildly, because by definition, the iron condor and even the iron butterfly is essentially the most neutral position that you can enter. You don't want the stock to move very far. You want to be out of the money. You want to have a good range out of the money. Here with MCI at 274.22, we're at the 230 strike and the 345 strike. 40 down, 75 up. A little bit more skew to the bullish side that I'd like. I'd like it to be more with almost 50% out of the money range. I'm going to explain that in a moment, William, so that I'm equidistant between the two at the start. Okay. Now, let's go back. What are our default criteria? This is our initial value default criteria. Well, we're looking for, reasonable net credit, reasonable return. You can adjust that to meet your targets. Range out of the money, 10% with that probability I mentioned, 75% static on the short put and the short call, with an 85% probability between. The theoretical probability the stock will remain between both strike prices at expiration. And then some basic volume. But again, looking for a lower beta range, not going above 1.25, and keeping the Bollinger bandwidth relatively close. Because I don't want something, as we just saw there, hold on one second. I don't want to see something that we just saw with the other position, William, as we were talking about with X, where we just saw that large bubble of the Bollinger Band, remember, on the charts. These are the Bollinger Bands. When I'm looking for an iron condor, I want to see something that's channeling, more like this right now, but this is showing a bullish skew, I'll admit that. But more like in here. This looks like a good time of a 2.5, 3, maybe 4-week period for iron condors, fluctuating between 23 and 26. That's what I kind of want, right? I want this lower Bollinger Band width. I don't want this width. Something that just had a recent blowout, a recent move. We want something that's staying in a trading range. But again, the accidents do happen. Now, I want to caution you on something here. William, you said that 10% out of the money is a 10 delta. No, that's not really accurate. okay? That's going to depend on the expiration date. It's going to depend on the implied volatility of the position. 10% out of the money does not relate to a Greek of 10 delta necessarily. Let's see here. I've got my probabilities shown. I don't have the percent out of the money. I have the upper and lower break even. I'm going to clean this up a little bit. I'm going to go into change columns here. And I thought I had it in here, I guess. Oh, okay. Let me just do this here. I will just do an example. What I want is short call percent out of the money and the short put percent out of the money. And I'm actually going to change the column order, William, and I'm going to move them up to, I'm sorry, upper, oh, probability between. I want them next to that. That doesn't really matter, but I just want them closer to that. Okay, so let's go ahead and submit the save. Close the window. All right. So perfect. Service now. October 21 expiration. An iron condor position, selling the 500 put and buying the 490 on a stock at 558.96. 615 short call, 625 long, 10-point spread, same margin on the spreads. I like to keep that checkbox there, the same margin on the spreads, William, to keep it simple, not skewing it to a 5 on one side and a 15 on the other. Just keep it simple, 5 and 5, 10 and 10. All right. Both positions are roughly 10% out of the money exactly. So that means that we're going to be near this out of the money range I typically look for. Usually I use this to be between 40 and 60%, meaning the stock is pretty much equidistant from the short call and the short put strike price. 500 call for October 21st. First, let's go to the option research tool for that particular option. The option research tool shows me some of the historical values of the position. I can compare implied volatility versus option bid since the option has been released in the market, delta, and so forth. But the delta here is 0.06. Yes, it's less than 10 in this case, but it's not 10 exactly. It doesn't equate to that directly. It's going to depend on a difference in implied volatility of the option. This one's at 0.343. Of course, the call is pretty much going to have the same delta. We know it's going to be around 0.06, Williams, somewhere around those ranges. Let's just take a look here. For this particular security, now we're at 0.126. We're 10% out of the money, but the delta is 12.6, almost 13. Is that a big difference? Well, it is. I mentioned that because if you were looking for positions where you just wanted the short call delta to be less than 0.10 or less than 10, and you wanted the short put delta to be less than 0.10, you wouldn't see this iron condor. It wouldn't be there because the delta of the call doesn't match it. Implied volatility is actually lower at 0.2769, but this delta, based on the past movement of the stock and how the delta is calculated, it doesn't equate. 10% of the money does not mean an exact 10% delta. And of course, if we go closer in time, I don't even know if this does, but let's go to the option chain for service now. Fantastic, does offer weekly options. A shorter term option, naturally, those same prices we were looking at, selling the, am I in the put chain? Yeah, good. Okay, selling the 500 put, our delta is going to be below that 0.10 very easily. It's still at about 0.006. But if I go 140 days out in time, the 500 strike put is at a delta of 0.246. Time, implied volatility, movement of the stock, that's all going to factor into the delta equation. Just being 10% money, 10% out of the money, William, excuse me, does not mean a guarantee that your delta is going to be less than 0.10. They're not direct correlations at all. It's a good start, 10% of the money, but the delta is a different animal. We had talked earlier about stock Rivian when we looked at the naked put screen, RIVN, and we showed those higher volatility positions. And we're just going to go to the weekly first. And okay, the first option that's 10% out of the money, okay, we can go ahead and call it the 22 strike. It's got a delta of 13, 11.5. It's about right. It's a delta of negative 0.9. It's close to the wheelhouse, William, that you mentioned, but it's not exact. A range out of the money does not correlate directly to the delta, especially when you factor in further time. That same 22 strike for Rivian, the delta is at 0.262 or 0.224, or what you might say 26 or 22, being 10% out of the money. Now, this could be due to a higher implied volatility rate out here. That's not that bad, actually, 0.6641, about halfway between its total implied volatility range. But again, it depends on the security, depends on the implied volatility of the options, depends on what events are coming up between now and that expiration date, an earnings, a buyout that we talked about for X a few moments ago. Those things are going to come into play. Okay, so deltas, things of that nature. We prefer to use the probability, which does relate to the delta a little bit more than the range out of the money that you mentioned. When I mentioned the range out of the money there, I want to look for something that has a lower beta, has a lower bandwidth. I don't want to look for something that's having a Bollinger Band breakout or something that's showing a trend upward or downward. I want stable to neutral for any iron condor or potentially iron butterfly. Okay. My criteria for resetting it, similar to the 8 ways I'd look to manage a bull put credit spread, meaning that we talked about that Bollinger Band range and the stocks being between it, okay? And I don't want something that's really gapped up above the 20-day or 50-day moving average too much in those cases, right? So I want something that's channeling. I know it's a terrible drawing of stocks in a trend. Typically, if the stock reaches 1% of my short call or my short put strike price, I'm going to look to manage the position one way or the other. Whether that's maybe not even be just moving it and recentering the iron condor if those triggers are hit. I might be closing the bear call side. I might be closing just the short call on the bear call credit spread side, or the short put if it's being threatened in that direction. We might do a pendulum adjustment on the side that's being threatened depending on where the stock is. I might not just keep moving up and down the iron condor or iron butterfly, because clearly what? I entered a position that I wanted to be neutral, where it wouldn't move beyond these positions, but now it's showing me strength one direction or the other, as per the previous conversation that we had. If the stock is going against the sentiment of the structure I'm in, why do I simply want to readjust to the same structure and risk taking further losses if it continues to move against me in that direction? Or worse, move the position and have it swing backwards to where I'm taking a loss when my initial position would be profitable. Sometimes it is better to take the loss on the position when you don't have the same sentiment and confidence that it's going to stay in your neutral trading range, that it's showing breakouts one direction or the other, and make it up in other securities that are showing you the pattern that you need for the underlying option strategy, as opposed to keep trying to roll and say, I have to turn this loss on now into a profit now or sometime later on the stock now. Doesn't have to be on this stock. It's okay to take a loss, cut the losses short, and move into more positions that are matching the criteria that you can search on PowerOptions, that have the trends that you want, are showing the probability you want at that time, rather than keep trying to outguess the stock that was wrong in the directional path you were with the first time as well. Okay. On that note, you know, we're took this to a few minutes, William, so you can see our discussions there. There's other aspects you can take a deeper look at if you go into the main Iron Condor page of PowerOptions. Come on, buddy. There's some help center there with some different videos that you can view. Basic strategy help. You're beyond that point. It's just learn the basics of the Iron Condor strategies, AM, PM settlement. There's several ones here, but a faster way that you might find what you're looking for is if you go to that YouTube channel, as I mentioned. Use the magnifying glass, the search icon here, and I can just search for Iron Condor. Let's just try manage. Iron Condor triggers and management, managing a short strangle, intro to Iron Condors, managing Iron Condors and much more. 0 days to expiration condors we hinted at earlier. let's just look at search for iron condors. Let's look at search iron condors. I know we had one in the last 2 or 3 weeks on this. Criteria to use for weekly iron condors, that's for 6 months ago. Finding good iron condors now that volatility is low. Discussion on criteria, setting up the search, what to look for when the volatility was low, when the VIX was back down in that 12 to 13 range, settings for iron condors, and so forth. In addition to that, let's just check the recent videos. I thought I had one. There's the bull put. Spreads on lower volatility ETFs. Really sorry there, William. I thought I had a recent iron condor position here. Maybe it was on this one, the search tool in action, removing symbols, specific searches, and more related to the iron condors. I just didn't name it that. But you can see the iron condor criteria discussion, management techniques, and others, both on sort of PowerOptions. There's some old ones there, and then there's some different ones, management techniques, credit spread, and condor returns. Other discussions there as well that you can get into. And you can see our default criteria that we prefer here. The initial values, as I mentioned, limiting the Bollinger Bands. We prefer to use the probability over delta. Probability does relate more to delta, but that range out of the money we talked about is not a direct correlation to delta, especially when you factor in the time value, days to expiration. That's going to fluctuate as well with the implied volatility. It's not a direct correlation. Yeah, but I want neutral to just channeling stocks. Don't want something that had a recent breakout or is swinging wildly. Yeah, they say the ones with a higher implied volatility offer the best premium. Yeah, but they also have the higher expectancy of moving against you one direction or the other as well. In addition to the default search, of course, you can also check out the sample searches, index and ETFs, iron condors, and iron condors for higher price securities, looking for ones above 95, and I believe with a high market cap as well for more safety and more stability in those scenarios. So different types of default and sample screens that you can use as a stepping stone, make the adjustments to match it. Talked about the criteria that we like to use for those positions, those underlying securities. And again, you can look up the Managing Iron Condors here on the YouTube channel for the different paths rather than just recentering the condor if it moves against you. What triggers might we use? What other ideas might we use to manage the iron condor? Even from 4 years ago, still a different one, still a reasonable one that I'd still do today with probably 85 to 90% of the same content. And for other insight into that, it's a bit longer, but one of our most popular videos, of course, is the 8 ways to manage a bull put spread, where we talk about the trigger points we'd use for a bull put and the 8 ways we'd look to manage just a bull put credit spread. But those are also some of the ways I might look at to manage the iron condor position, whether it's moving against me on the bull put side or on the bear call side as well. Could also relate to the butterflies, but that's a little bit more of a different animal where you have less movement that you can tolerate before you have to adjust one side or the other. But hey, you did get that higher premium so that you will have more of a better starting out upper and lower break even in that scenario for the butterfly due to the higher premium. But you also have less wiggle room before one of those options goes in the money, as naturally at a butterfly as you're selling the same 2 strikeout options. I'm sorry, you're selling the same at the money strike options there, William. So you want to take action. You probably need to take action faster in those scenarios. And the butterfly as opposed to the condor as well.